Hello, everybody, and welcome to our first lecture on our financial statement analysis project. So, in our next class, we are going to actually start working on our project. So, before we start working, I thought you guys needed to know a little bit of information going into it. First of all, what the heck is financial analysis? Before we can do it, we need to know what it is. Secondly, I'm going to teach you one of the tools that we use for analysis, and that is ratios. Now, you may have heard that term ratio before at some point in your life, probably in a math class, but I'm going to talk to you guys specifically about how we use ratios in accounting. And then last, I'm going to teach you one specific ratio, return on assets, which is the ratio that you guys are all going to be calculating in our next class for your particular company that your team chooses. So when we talk about what is financial analysis, I really like the image of this magnifying glass for a couple of reasons. So first of all, the magnifying glass kind of signifies taking a closer look at something. And that's certainly what analysis is. Okay, we're going to be taking a closer look. But I also think that the image of a magnifying glass makes you think of like a detective. And that's really what we're doing in the analysis process. We're playing detective. We're trying to solve a mystery, to answer a question. And we need to take a closer look and put together clues in order to solve that mystery or answer that question. And so essentially that's what we're doing with our project, okay? The question that we're trying to answer is, should we invest in this company? And so now we need to look for clues from the information provided in order to answer that question or solve that mystery. And that's the whole purpose of the project that you guys are going to be doing. So to reiterate, I think you guys have seen this slide before, but the definition of accounting is an information and measurement system that identifies, records, and communicates information about an organization's business activities. Okay, so the whole purpose of the accounting cycle process that we went through was to be able to communicate the information about a business. And we do this communication through financial statements. Okay, that is really the final product in the accounting cycle. That's the deliverable. That's the thing that the reason why we do all of that is so that we can provide these financial statements or reports about what the company's doing. Okay, and again, the purpose of those financial statements is to communicate financial information, and we use that information for decision-making purposes. And there are a lot of different users of financial information, both internal users and external users. And by internal, I mean the management of the company, the people actually running the company. And external, of course, is the two primary external users of financial statements, which are investors and creditors. And so those financial statements really do communicate information. So, for example, the two primary financial statements that we've already learned about, which is the balance sheet and the income statement, they communicate information to us. The balance sheet answers the question, what does the company own? Okay, and the income statement answers the question, how much money did we make as our business? And so that information is useful in many ways. So for example, if we have two companies here, Company A and Company B, and our question is which of these two companies should we invest in? One thing that you might look at in order to make that determination is which company makes more money. And in order to find out which company makes more money, you need to look at their net income. And which financial statement will we find the net income on? Yes, that's right, the income statement. And by the way, throughout this project, you are going to get more and more familiar with what is on each type of financial statement, which financial statement provides which type of information. So I'm going to be asking you about that periodically. Okay, well, where would you look to find that? Where would you look to find net income? We're going to find that on the income statement. Okay, so when you look at your income statement of these two companies, Company A and Company B, let's say that Company A says that they have $10,000 of net income, and Company B says they have $50,000 of net income. Well, which one would you choose? Well, let's think. Do we want a lot of net income or a little net income? Well, net income means the money you're making. So I think most people and most companies would want to have a higher net income, right? So if you think, oh, well, higher net income is definitely what I want, you're going to say, oh, I want to invest in Company B. Okay? So that answers that question. But now, let's look at maybe some other information the financial statements provide. Let's say we want to say, okay, which company should we invest in? Well, the company maybe that owns more stuff, right? Well, the way that we find out how much a company owns is through its total assets. Okay, assets are the resources that a business owns. And where would we find that? Which financial statement would we look for if we wanted to find our total assets or how much we own? That's right, the balance sheet. Okay, so if we look on our balance sheet for Company A, it says Company A has $100,000 of assets and Company B has $1 million of total assets. So, gee, let me think. Which one would we want? Would we want more total assets or less total assets? Well, if assets are what we own that bring future benefit, I don't know about you guys, but I want more future benefit, right? Not less. So, if you wanted more future benefit, then you might say, oh, Company B is the better option. Okay? But there are limitations to the information that can be provided by the financial statements. Okay? So, the financial statements could tell you what the net income was, how much money they made. And the financial statements could tell you their total assets or how much the company owns. But what it doesn't tell you is the relationship between these two numbers. Okay? These two numbers are actually related. Because if you think about it, assets are resources the company owns that brings future benefit. And most of the future benefit related to assets is their ability to help the business run, to help the business make money. So, for example, an asset is cash. Okay, we need cash to be able to pay our employees, to pay our rent, to pay our insurance, all the things that we need for our business to run. Okay, we wouldn't be able to make any money if we didn't have employees, so we need cash. Another example of an asset helping us make money are supplies, right? We need our supplies to be able to write our reports and depending on the type of business you have, if you're a hairdresser, you need your hair cutting supplies to be able to cut hair. Otherwise, you wouldn't be able to make money. Okay, so supplies are an asset that help us make money. Okay, equipment, automobiles, all of that stuff. We use our equipment and our automobiles and our computers to help us do our job to be able to provide the services that we need to provide to our customers. So your total assets, again, contribute to your net income. So these two numbers are related. Your assets help you make net income. Okay, so in order to pull more information out of the financial statements than just what's out there at face value, right? On the face of the financial statements, we see the assets and we see the income, but we can't see the relationship between the two and how well our assets are helping us to generate income. Okay? The way that we find the relationship between these two things is through ratios. Okay? And a ratio is a simple mathematical tool that reveals the significant relationship between two numbers. Okay? So these two numbers are related. So let's come up with a ratio or an equation that will show us the relationship between these two numbers. Okay? And that ratio that will show us the relationship between those two numbers is what we call return on assets. And you can read a little bit about return on assets in chapter 1. In the back part of the book is a section called decision analysis. You can read about it there and see what the formula is, but I also have the formula right here. The formula is net income divided by average total assets. And what average total assets is it's we know that our assets are going up and down and changing all throughout the year. So what we do is we take an average of our assets for the year. So that's the assets that we had at the beginning of the year and the assets that we had at the end of the year. And we take an average of the two. Okay? And if you take your net income and divide it by your average total assets, it shows you how much profit or income the company was able to generate using the assets they have. Okay? So it doesn't just tell you how much money they made or how much they own, it tells you how well is the company using those assets to help them make money. So, in other words, how efficiently were they able to use their assets or resources? So let's take a look at this example with Company A and Company B. Okay, so we all said that we would pick for net income Company B because they have higher net income, and we all said that for assets we would pick Company B because they have more assets. But if you really stop and do the math on this, you might come up with a different answer. Okay, so for Company A, if we calculate return on assets, we take net income of $10,000 divided by our average assets of $100,000, and we get 0.10. And return on assets is generally expressed as a percentage. So what you're going to do is you're going to convert your decimal to a percentage by moving the decimal 2 places over to the right. And that will show you that the return on assets for Company A is 10%. Now you take a minute and calculate what the ratio is for Company B. So, hopefully, if you took the time to calculate that, you will see that for Company B, the return on assets is the net income of $50,000, which is right here, divided by the total assets, which were $1 million, right here. And if you take 50,000 divided by 1 million, you get 0.05. Okay, now again, we want to convert that decimal to a percentage by bumping the decimal 2 places over to the right. And that tells us that our return on assets for Company B is 5%. Okay, so what that tells us is that even though Company A has fewer assets, they're using their assets to generate a higher percentage of their assets back as income. They're able to take those $100,000 of assets and make 10% of income, whereas Company B had $1 million of assets, but they were only able to make 5% of that back in income. So now that you see the relationship between the two, you've actually pulled more information out of those financial statements than just what was, right on the face of it. And you found out not just how much they made and how much they have, but how efficiently were they able to use what they have to make money. And hopefully you will be able to do the same thing in class with your company and play detective and determine which company is better.